Hello everyone and welcome to Fun with Fitzy. What is not reviewed is this payroll and employee benefits. When you are an employer, which means you hire people, you have to record payroll, and there's two journal entries. One to pay your salaries expense and the other to pay what we call employer, let's do this, benefits expense. So let's go through a couple things here. So salaries or wages payable, this is the liability that we're talking about, represent the amounts owed to employees for a pay period. And we withhold items. So payroll withholdings include federal and provincial income tax, which is the tax you owe to the government when you make income, Canada Pension Plan, which is what CPP stands for, and you pay money from your earnings each paycheck, and you start putting money into CPP for when you retire, you can collect a small pension from the government. And of course, you also have to pay EI, which is employment insurance, so that if you lose your job, you can collect some money so that you're insured against the loss of your wages. Employees may also withhold other things voluntarily, things like charities, like United Way is a good example of that, and other things. So withholdings are remitted to the government and other agencies every time you're paid. So let's look at a journal entry. So as you know, if you're working, let's say you've earned $100. That's called gross earnings. But you only take home, let's say, $60. That sucks, I know. That's called your net earnings, because from your gross you have to subtract all of these things we're talking about, withholdings. So let's take a look at it as an example here. So where did this $40 go? Well, $40 went to CPP, EI, went to income tax, etc. So this $40 is split up among those things that your employer will keep from your paycheck. So they'll give you 60, you've earned 100, and they will keep the 40 and pay all of the different organizations that you need to pay. So that's what this first journal entry is right here. We talked about the first journal entry. Well, the first journal entry is the entry for the employer to record $100,000 payroll. So let's say their employees earned $100,000. Of course, we have an expense then of $100,000, salaries expense or wages expense, whatever you want to call it. And from that, that's called your gross earnings. The employees only get to keep $60,000. That's their net earnings, salaries and wages payable. So while they've earned $100,000 and we have this expense, we're only going to owe them $60,000. And that's a current liability for us. But we also have all these other current liabilities that make up this other $40,000. One is CPP, what we talked about up here, EI, income tax payable, United Way, that's this charity, and union dues. If you're part of a union, they will take money off your paycheck for union dues. You owe money to the union. Okay, so that really sucks. You've earned $100,000, but you only get to keep 60. I know. It's one of our luxuries of living in Canada. What you need to know out of this is how to journalize all of this. So the salaries, wages, expense, and this should be given to you, okay? However, what you're going to need to know is the second part of this. So keep that in mind. The second journal entry, the employer benefit expense, is right here. While you also owe your employees that $60,000 because they've earned $100,000, you as an employer have expenses, and some people call them employer benefit expenses, because the employer also has to pay CPP, EI, and other things. So if you are, let's say we're Fitzy Co. and you are Jan. Jan has to pay CPP, EI, blah, 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 blah. And Fitzy Co. also has to match what she's paying in CPP. She has to pay, Fitzy has to pay EI, which is 1.4 times what Jan had to pay, and so on. So both Jan and Fitzy Co. has to pay these things. So, like I said here, this CPP that Fitzy Co. has to pay has to match the employees, and the EI is 1.4 times what the employee had to pay. So let's just test that theory. Let's go back to the other one here. So the employee had to pay 2250. So if you take 2250 times by 1.4, you will get 3,150. So keep that in mind as well. Again, just for review here, we have 2 journal entries if you're an employer, one to pay the salaries expense and one to also pay all the benefits that you also have to have as an employer. Okay, as a review, salaries, they've earned 100,000, they only get to keep 60,000 because you're withholding all of these things and you're going to pay on their behalf. And when you post these, they're going to end up in your accounts, and when you pay them, you'll be clearing those accounts. Also, when you post these, they'll end up in those accounts as well. So that's about as much as I want you to know about payroll for now. Let's talk about unearned revenue. Unearned revenue are advances from customers. So they pay you in advance for providing a service or doing something for them. Okay, so it's cash before a service is rendered. So you haven't earned the revenue, you just got cash ahead of time. So it's actually a liability. This is why we're talking about it right now, because we're talking about current liabilities. And we're talking about definitely determinable liabilities. Have you figured out what definitely determinable means yet? Definitely determinable means you can definitely determine the amount, when you owe it, and to who you owe. Okay, so for example, this unearned revenue, well, we know when we owe it, who we owe it to, and the amount. With the payroll, we know who, when, why. With the HST, we know who, when, and how much, the whole bit. So that's what a definitely determinable liability is. Okay, they're the straightforward ones. So let's look at this example of unearned revenue. Superior University sells 1,000 season hockey tickets at $200 each for its 25-game home schedule. So 1,000 tickets times 200 each equals $200,000. So we, Superior University, got $200,000 cash, and we have an unearned revenue, which is a liability, which is why it's a credit. Now, as the games progress, there's 25 games, as each game is played and these seasons pass holders attend the game, we've earned some of our revenue, which, as you know by the revenue recognition principle, that you need to record your revenue when you earn it. So as we earned it, let's say one game went by, so 200,000 divided by 25 games equals, so every game we play, we earn $8,000. So after one game, we're going to debit that unearned revenue because we no longer owe them that $8,000. But now we're going to credit our revenue account. So that's pretty simple for revenue. And last but not least here, we're going to talk about current maturities of long-term debt. This is quite simple. We've talked about it already. Another item classified as a current liability is current maturity of long-term debt, i.e. mortgage, the portion due in the year. So you know your mortgage is usually amortized over 25 years or 20 years. Well, some of it's due this year. So you have to include that portion of your mortgage in your current liabilities because it is a current liability. Okay, so companies often have a portion of long-term debt that will be due in the current year. And current maturities of long-term debt are often identified on the balance sheet as long-term debt due within 1 year. That's the name that we call it. Sometimes it's called current maturity of long-term debt. Anyways, by now you should be able to name the 3 types of current liabilities: definitely determinable, estimated, and contingent. We're going to talk about those last 2 in the next videos. And you should be able to do the accounting, the journal entries for the definitely determinable liabilities, specifically notes payable, HST payable, salaries and wages expense, as well as the employer benefits expense, plus unearned revenue and current maturities of long-term debt. Thanks for watching. Hope this helps.